Should you use a bank or should you use your whole life insurance policy to take a loan against for your next major purchase or investment? It's a question that a lot of people ask, and if you talk to most like infinite banking practitioners, they're going to tell you that the purpose of doing this policy is to take over the banking function in your life, i.e. run as much of your money through your policy as possible. And the purpose and the reason that you're getting this policy in the first place is to eliminate your need to utilize the banks. I'm gonna tell you right now, I don't agree with that sentiment. I don't believe in that philosophy. And I think mathematically, it just doesn't make sense. So in this video, what I'm gonna do is I'm gonna walk you through the 4-step process I utilize to figure out, do I wanna utilize a bank or do I wanna utilize my whole life insurance policy loan provision to be able to deploy that for whether it's a major capital purchase that I'm making or whether it's an investment that we're making. So if you haven't already, make sure you're subscribing to the bell, that way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and this video is sure to get some feedback, both positive and negative on both sides of the pendulum. This is an area that a lot of people have a lot of opinions on. And for me, I just look at it and I think it's a mixture of a math conversation and a skill set conversation. Now, I'm gonna tell you right now, it's not a matter of just math when it comes to policy loans. It really is a function of understanding who you are, what your skills and abilities are, because access to capital and having deployable cash at the ready is gonna have different values to different people. The value of control has different values to different people of capital, right? And so I think that's important to understand that when we get in here, one of the reasons that I love whole life insurance in general is because of the liquid nature of the cash value in the policy, and the fact that you control that cash value is a huge benefit. It's one of the underlying foundational benefits that I think is a key reason that I think everybody should utilize properly designed whole life insurance policy as an emergency fund and an opportunity fund in their life. That said, when an opportunity is presented to you, whether it's an opportunity to buy your next car, which I'm not the biggest fan of, utilizing a policy loan for that, although it can make sense and you can be more efficient with your capital, I would say you want to make sure you save enough money in your policy to be able to buy your next car. Whether you decide to do it through your policy, we're going to go through it and see if it makes sense, if it's the right decision for you. And whether you're doing that or whether you're buying a cash flow producing asset like real estate, the question is what are your options for capital and what are the downsides to those options for capital? Because make no mistake about it, there's always a potential downside to every decision that we have to make. So we have to evaluate both sides of that spectrum. So that said, the first thing that I always take into consideration is what is the value for you to have access to capital? Because when we think about it, when we're borrowing against our policy, we are losing access to that capital, and the value of access to capital is different for different people. I want to go to my board right here and I want to talk about this for a second, because this is a really important concept to understand. So think about it this way. If you had cash value of, let's say, $200,000, and you could take a policy loan, and that policy loan, let's just say 5.5%. Well, and let's say you want to take 100,000 at 5.5%. Well, now your collateral capacity is minus 100,000, so you really only have 100,000 in collateral capacity left, right? Because that's 200 minus 100 is 100, right? So now you've lost access to $100,000 out of this $200,000. Now, of course, there's benefits here, and we're going to talk about that in a second. We're going to talk about the cost of the money and so on and so forth. But at the end of the day, the fact is you have to figure out, is there a value to the loss of access to capital, or for the benefit of having more access to capital by avoiding the policy loan and utilizing a bank loan, even if it were more expensive? Let's say it was 6% for a bank loan. Would it make sense to use a bank loan instead of a policy loan just because we're going to maintain access to the capital? There are different variables that go into that. It's going to have to do with your cash flow and some other variables that we're going to get into here. But ultimately, that's a really big thing to consider. The first thing that I would consider is what is the value of that access to capital, and understanding that utilizing a whole life insurance policy loan is going to reduce your access to capital. So in different times, different economic environments, and for different people, that value is going to change, but that is absolutely the first thing that you need to consider. The second thing you need to consider is the flexible terms of those loans. The one great part about a whole life insurance policy loan is the fact that it's got completely flexible repayment terms. With banks, with lines of credits through banks, you typically have at least interest-only payments that you have to pay every single month. And you, if not, having principal and interest payments every single month. And if you don't make those payments, it can have a negative impact on your credit. And sometimes, let's face it, maybe you won't even qualify for it. And so having access to it in a whole life insurance policy loan can give you access to money that you wouldn't even be able to access otherwise, right? Like I'm doing a lot of stuff down in the Dominican Republic that you can't get financing for through traditional bank, and having access to capital opens up opportunity that you wouldn't have otherwise in a lot of situations, right? And so that's something to take into consideration. But when we look at the flexible terms of the loan, it depends on what the asset is. A lot of people want to go out and do maybe a flip of a home. They want to do an investment project, and they know they need terms for like 6 months to be able to go out and get a home. They want to fix it. They want to flip it. They need to get a loan. And if you do it with a bank, you have to manage the interest for all 6 months a lot of times, unless you're doing hard money with special provisions or whatever. But you by managing that, or by getting involved in this project that's not going to be producing cash flow during that term, it makes sense a lot of times to utilize a whole life insurance policy loan, because there is no repayment requirement during that time. You can just wait until you exit the deal, till you liquidate the property and sell the property, take your profit, pay the loan back, pay the interest back, and you're good to go. So after figuring out what is the value of the opportunity, having access to the capital, and then you figure out what is the flexibility of that loan, those are the first two things that I take into consideration. Then the third thing that I look at is the cost of money. Now, this is what I was talking about before. Money always has a cost to it, right? And one of the things that I think is really important to understand is that when we're looking at the cost of money is, with a whole life insurance policy, a lot of people say, like, I'm going to pay 5.5% interest rate. We're going to pay a rate of 5.5%, but their idea is that you're going to be earning all the while. Now, this idea of positive arbitrage in whole life is not all it's cracked up to be, but let's say you could earn 4.5% on that policy, right? So the idea here is you have like basically a negative 1%. So it's like a 1% cost of money. That would be effectively your cost of money. Now, that's not exactly what the cost of money is, because at the end of the day, you're paying a simple interest, and this is going to be growing on a compounded nature. So it's not an apples to apples conversation. And I could show you mathematically, I'm not going to get into this in this video, I cover it in other videos. I could show you mathematically why it makes sense to even have this negative 1% arbitrage, because it's not really negative 1% when we're comparing simple interest to compound interest. And that's just kind of like a side note that I wanted to make sure is really understood. But what needs to be understood is this idea of cost of money. And the fact is that this money, your account, the one variable, if you utilize a non-direct recognition company, and what you're going to realize is this 4.5% right here, this 4.5% is going to grow at 4.5% regardless. So the variable that comes into play is this 5.5%. If we can go get a rate at a bank for 4%, now that's where positive arbitrage can come in, because we're going to pay this through a bank. Now we have to re-question our second question here is, what are the terms of this? How flexible is this money? And are we able to manage that flexibility? The one thing to understand, the reason I like this, even if you're not that flexible, you can always use policy loans in months of hardship when you're looking to make that payment, to take smaller policy loans to keep more capital control and kind of manage it that way. It's a little more work, it's a little more effort, but to me, that usually makes the most sense. Anytime we can get the bank to provide us a cost of money lower than the policy loan provision, then to me, most of the time that makes sense because you always have access to the capital inside of the policy to make the monthly payment and borrow against that if you need to in smaller chunks, which just makes sense. Now, the next reason, the fourth reason that I think or the fourth question that you have to ask when it comes to doing this is, what is your bargaining power? What is the leverage? Because when we look at the cost of money and we look at bargaining power, when we're looking to maybe make a major capital purchase, when you're looking to make an investment in a cash flow property, it's important to understand that sometimes having access to capital is everything. You know, I did a podcast with Garrett Gunderson. He was talking about his podcast studio and his mountain cabin in Utah where we were recording the episodes together. He was able to get that because he had access to money in a policy loan. He was able to close on the property in 9 days when everybody else was using bank loans that were going to take a lot longer to close, and there was urgency on the owner to close. And so that opened up an opportunity for him to get a place that he wasn't going to be able to get otherwise, right? That's a big deal. I utilize my example of our camper trailer that we had. I sold it. And the crazy part is this camper trailer had an MSRP of $29,995, so basically $30,000. So the MSRP of $30,000, they wanted to give me a good deal at 4.9% financing. Now, it's okay. I could look at 4.9% financing. Let's say it's 4.9 and the policy loan would be 5.5%. I could look at that and be like, all right, maybe that makes sense, right? Like to do that. But the cool part is just the nature of having the money in the policy gave me the bargaining power and the leverage to barter with them about what is the price of this vehicle going to be, because anytime you're able to pay cash, you're able to negotiate and come from a place of power. Now, this is a skill set that you have to learn. This is something that you have to evolve at and get better with. But the bottom line is, for me, going in and having access to the capital and the ability to pay cash for this trailer and not have to deal with a financing company allowed me to talk them all the way down to $19,990. That was 33% off this trailer. And so what happened was I was able to buy this trailer for 33% off. We utilized it for 2 years, got a lot of life out of it. I even rented it, cash flowed it 40% while I was utilizing it. And because I bought it at such a good deal, I was able to then liquidate it, flip it, sell it for more than I paid for it, right? So think about the value of that. I was able to do that all because I had access to capital. Did I end up using the policy loan? I did. And did I pay a little more for the policy because I was able to, a little more for the interest rate than I would be able to finance through them? Sure, I did. But at the end of the day, I was able to pay a higher interest rate on a lower purchasing price, which is the biggest deal in the world. So when you're looking at doing, considering whether you're utilizing a bank or whether you're utilizing your whole life insurance policy loan provision, those are the 4 questions that I would walk through. If you have any questions about it, leave them in the comment section below. I'm happy to engage with every single one. If you have any questions about this, you want to get on the phone with somebody, go down below in the description. There's a link to be able to figure out, set up a time to have a conversation, a clarity call with somebody on my team. Happy to help you out. Happy to give you clarity on this to figure out what it could look like in your life. That's it for now. Till next video, have a blessed, inspirational day. If you haven't already, make sure you like, subscribe, hit the bell, all the things, and we'll talk soon. See ya.